Investors can't seem to catch a break when it comes to Nvidia, with the stock falling 58% down from its high in November, driven by one bad news story after another. And just when you thought it couldn't get much worse, the US officials have banned the sale of high-tech AI chips to China. So in this video I'm going to be explaining what's been happening with Nvidia, why I've been shorting the stock, and where I think investors should be looking if they want to invest in the semiconductor industry. Of all the companies to benefit from the pandemic, Nvidia was right at the top. From its pre-pandemic high of $73, the initial market crash saw it drop 30%. But this was just a bump in the road to a rally that saw it climb to a high of $329 last November. But with the stock since falling to $136, something seems to have gone wrong and investors are feeling the pain. The pandemic created a stay-at-home environment and the gaming industry boomed as a result, with people spending more time playing online remotely with their friends during lockdown, and pushed even further by Microsoft and Sony releasing their next generation consoles in late 2020. With Nvidia providing market-leading graphics cards, they were poised to benefit from the gaming market, which PricewaterhouseCoopers reports to have grown 10% in 2020, and it forecasts it to grow at a compound annual growth rate of 4.4% into 2025. Compare the 2020 performance of the global economy, which shrunk 5.1%, and the global entertainment and media industry, which fell 3.8%. Secondly, we had the cryptocurrency rally. With Bitcoin the main contender, the COVID crash brought it down 41%, but much like the Nvidia, not only did it recover within a couple of months, but it saw a similar rally. Despite the volatility, Bitcoin hit a high of $64,000 last November. With miners relying heavily on the most powerful GPUs to mine the currency, Nvidia was gaining $1.5 to $1.8 billion per quarter in revenue. But reliance on the crypto market was a double-edged sword. Nvidia's traditional revenue streams from gaming, data centers, media creators and automotive markets can be valued and forecasted by analysts and investors familiar with those industries. But the crypto market has proved far too speculative and volatile. Consider how crypto prices were so easily influenced by market manipulating tweets from Elon Musk, who benefited greatly from the rise in Dogecoin whilst he used his influence to crash the price of Bitcoin.
So it's a hustle. Yeah, it's a hustle. I ain't just say that, man. Don't fall to everybody. It's a hustle. To the moon.
It didn't help that Nvidia was less than transparent over their exposure to the crypto market, failing to mention in their earnings reports how much of their growth was a result of GPU sales related to crypto mining. Although the gaming industry was taken off, sales of high-end motherboards, a key component for gaming PCs, were far short of the sales of high-end GPUs, suggesting PCs were being built with one purpose in mind. Just comparing the stock of Nvidia to Bitcoin and Ethereum, and there are signs of a link between their performance. Nvidia's failure to communicate to investors resulted in them paying a $5.5 million fine to federal securities regulators. Investors had a reason to worry about Nvidia's link to crypto, as numerous crypto companies failed to hold their values for investors as people turned away from the currency. It certainly didn't help with the last trend of NFTs, a laughable concept which I think showed blockchain technology had become a bit of a farce. There is a third element here, and that's a general semiconductor shortage, and with the advancements of automakers, technology devices and the demand for military hardware, semiconductors are becoming increasingly more important to those industries. But the problem here is something called the bullwhip effect.
That's a cool whip.
This is essentially when manufacturers react to an initial increase in consumer demand for a product, ramping up their manufacture, and the suppliers pick up the same demand and react the same way, creating a ripple of overreacting to high demand that travels down the production chain like a bullwhip. But one of two things are going to happen. The supply and demand ratio is met and the industry is met with overproduction, or a bottleneck is reached by one part holding up production and everything else hits a stalemate. The stalemate here is due to macroeconomics, with the majority of chip companies sourcing their physical manufacture to Taiwan. The rise in tensions with China have led the US government to realise they have effectively put all their eggs in one basket, and as the war in Ukraine has taken a significant toll on their military reserves, the lack of domestic chip manufacture is creating a national security issue, and with companies like Nvidia and AMD spearheading technology innovation, they are easy targets. The CHIPS Act, which I covered fully in a recent video, was aimed to address this issue, but it is going to take years to develop the production infrastructure planned, on top of a lack of the highly skilled workers engineers required to fill the technical roles. So although it's good for the chip industry over the long term, any immediate impact on the stock of companies like Nvidia is likely to be short-lived, and companies with domestic production facilities are going to benefit the most from the plan. The data suggests that Nvidia and semi companies in general have reached the peak of a cyclical trend, and with these stocks coming back down, I anticipated that Nvidia would fall the hardest. But to my annoyance, the company released a pre-announcement to this effect 2 weeks early before their latest earnings, before I had set up my short position. That report took the stock down over 7% and roughly a 21% return I missed out on. But despite Nvidia warning their investors, I set up my position in time for the Q222 earnings on the 24th, expecting a reduced but still substantial return. But annoyingly, the stock went up by over 4%, despite missing expectations and giving poor future guidance. The issue here is Nvidia has become one of these idiot stocks where every investor wants some exposure for their portfolio for the mainstream appeal of the company, and hedge fund managers have had to own a piece of the company to appease their clients. Even with the stock falling over 54% year to date, it's these type of investors that would tell you it's fine as they are taking a long-term view of the company. It frustrates me that this term is used like this, as it's often a sign of ignorance when investors buy and hold on to a stock that has clearly peaked, because they don't know when to sell or take profits off the table. Let the market cool down a bit before buying more at a reasonable valuation. It's not selling out your convictions or trying to predict the market, it's recognising that even the best companies go through peaks and troughs, and where bulls and bears make money, pigs get slaughtered. If Kiss of Death Cathie Wood sold Nvidia before earnings, then you know it's got to be a loser. Fortunately for me, I held my short position, and lo and behold, Powell's Jackson Hole speech on the 25th was exactly the catalyst I needed, threatening even tougher actions to slow down inflation, seeing the stock fall 9.23%, and the result of these ups and downs for me was a return of 16.67% within a matter of days. But I was surprised when the US government told the company they had to stop exporting their high-tech chips to China, citing national security concerns. It seems nobody saw this coming, except maybe Paul Pelosi, who has eerily good timing when it comes to the market, with some highly suspect trading around Nvidia given the conflict of interest through his wife. Which not only brings about accusations of insider trading, but a debate on whether lawmakers and their spouses should be allowed to trade stocks. A discussion Nancy Pelosi refuses to have.
Absolutely not. Okay.
Dodgy! But let's stay focused. This latest ban from the US is focused on two specific Nvidia chips, the A100 and H100. The A100 is designed for high-performance data centers with features to enhance storage and network capabilities, and the H100 is their latest enterprise accelerator chip and designed for exascale workloads, language models, and conversational AI. The concern of the US government is that these chips could have a military end use in Russia or China, and Nvidia is now one of several companies who will require a license to export chips to China, the other being AMD in relation to their M1230 AI chips. Nvidia expect the impact of this to be around $400 million in sales this quarter, but over the long term, the ban could force them to move operations outside of China. Given the geopolitical stage, specifically the toll the Ukraine conflict is placing on the US weapons reserves, along with the rising tensions with China over Taiwan, made worse thanks to Nancy Pelosi's recent visit. Dodgy! It's no wonder the US government is finally having to rethink how much longer they're going to tolerate China stealing intellectual property from their technologies, when they could be using that to develop military capabilities to rival the US. If you were to unpack the growing awareness of the threat from China's government, Hawaii products sold at a loss to gain a foothold in US communication systems, the accumulation of mining companies needed for battery production, the purchasing of farmland near government sites, it's a wonder more hasn't been done about China sooner. But hey, people want their cheap iPhones. But the move is significant because for as long as China has been stealing intellectual property for years, it's because they cannot innovate. Any Chinese companies that try are often brought back in line with the PRC's agenda of mass conformity to communist values.
Hello, darkness, my old friend.
And as tensions continue to escalate, the US government may continue to use this strategy in reining them in, and the companies most likely to see these types of innovations are going to be market leaders. With numerous semi stocks coming down from their highs, many investors are going to see this as an entry point, but I'm keeping far away from the biggest names. There's no incentive to get involved at their present levels, as we're currently looking at a cyclical downtrend and there's plenty of room for them to continue downwards. The industry is bottlenecked by the limits of production and reliance on Taiwan relations, and even with the CHIPS Act focusing on domestic manufacture, it's going to take years for these companies to build new facilities and acquire a skilled labour force. For that reason, it's best to avoid hype names and focus on profitable domestic markets. If you want exposure to the chip industry, there are alternatives to the big media names, with the likes of Micron showing decent financials and just announcing a $15 billion investment into a new fabrication facility, and being an American company, they're supported by the recent CHIPS bill. NXP are doing well, and as the second largest supplier of chips to the auto industry, with $11 billion revenue last year, they stand to see some decent growth over the next few years as they catch up with demand from the industry. And despite being a Dutch company, they operate around the world and have 4 USA production facilities, 2 in Texas and 2 in Arizona. Or you could go for the German counterpart Infineon, who are number 1 in the industry with $12 billion last year, largely due to their European market presence. I'm holding 2 positions in the industry. Qualcomm, who not only hold key patents to many technologies, but they are also expanding into the auto industry through their Snapdragon digital chassis. And you can see my deep dive of this company on my channel. But I have cut back my position with the company to invest in Applied Materials, who supply fabrication equipment to the industry. They just exceeded expectations in their last quarter earnings, and I think they are undervalued compared to their competitors, so I will likely cover this in a later video. I will continue to look for opportunities to short Nvidia, but this is not a strategy for everyone, and I would discourage anyone from doing this via CFDs. Now that's my take, and if you have any thoughts, please comment below and let me know, and if you like what you see and you want to see more, smash the like button and subscribe. Until next time.